there's a unfortunate disadvantage for anybody who's trying to learn on their own in this day and age. There is so much noise and so much being thrown at you. Everybody's got their Discord channel, everybody's got their YouTube stuff. Like it, and there's in that lots of really, really great stuff. But how would you know? Like, how would
Yeah.
you know if it was effective or not? I find lots and lots of developing traders, especially self-directed retail, who are of this perspective that every price is actionable and
Hmm.
every time is actionable. And that is just categorically not true. Um, there are better times to trade and there are better prices to trade. And if you don't know that, then what will typically happen over time is, I mean, you will be just like glued to the screen because you think that there's something to do at every moment. And I I talk to young traders who are like, oh man, the dream is to be at my screen like trading. Like do that for a decade.
Hmm.
You would rather do something else. There's this myth that trading is this mystical thing that is just really unique from any other industry, and the reality is the same disciplines that would make you be successful in most industries will make you successful in trading.
Hmm.
Um, but you got to do the work, and you have to do the work around the things that actually will move the needle. Now, I would say that is a unique thing about trading is that there are other industries where the ability to find the thing that move the needle is easier than trading because we have closed floors, and so unless you're going to go work for a prop shop or a market maker or a quant fund where you can actually get inside the institutions and see what inputs they're actually looking at, it's a little bit like trying to find a needle in the haystack. But the lack of confidence and the um, emotional stuff, like that's all a function of the fact that you don't know what you're doing. Hey brother, welcome. Thanks for letting me come be part of this.
Good to have you back. I very much enjoyed our last episode. It's probably been a good year or so, I would imagine, at least
Yeah.
several months for sure. So why don't you just kind of catch me up quickly? How's everything been since the last time we talked?
Let's see. Just life, right? Trying to figure out how to. I mean, I think this is the challenge for anybody in this space: is how do we uh, orient around the things about markets that don't change, and how do we adapt to the things that do? And I mean, I'm seeing behaviors that are new to markets that I'm not accustomed to, and so
Okay.
in a form of continuous improvement, you always got to figure out how do you adjust and fold that in if you want to stay in the game, which is the objective, is to be able to stay in the game. So um, that's been a lot of what I've been doing. I've also been spending a lot of time with large language models doing as much automation as possible, so that
Hmm.
I was just watching some of your listeners will no doubt know Linda Raschke if you've ever read any of the Jack Schwager Market Wizards books. Um,
Yep.
Linda's a market wizard. Yeah, I'm friends with her husband, Damon Pavladas, and I was watching a video that she gave at I think it was like the Money Show years and years ago, but she was talking about, as much as possible, reserve the calories for when you need to make the decision and automate everything else.
Hmm.
And I think since with the advent of things like OpenAI and Claude and Anthropic and some of these large language models, it's given us the ability to take software development. The marginal cost of software development has gone to zero, and I find myself writing in all kinds of different scripts that I don't like. I didn't know any of this stuff,
Yeah.
but it can teach you, right? So you're like, oh, I want this indicator for this, or I want to be able to see this thing, or I want to be alerted to that thing. You can build that now. Where in the
Wow.
past it was pretty. There's a pretty high bar. So that's where I spent a lot of my last year has been just kind of working around some of that stuff.
Oh, very interesting. Okay, so specifically with the language learning models and the automation, this isn't something you're trying to necessarily outsource to a developer. This is something that you're bootstrapping as far as learning it from scratch and teaching it and
Yeah,
learning how to do it.
yeah. One of the challenges around development, because I've done that too, where like I've hired guys on Fiverr and Upwork to do different things, but they're not domain experts. So they may be an expert in Python, but they're not an expert in what I'm looking to see. So I mean, here's a really nerdy nuance around that is was building a model that was generating multi-leg option strategies, basically, queuing up, hey, here are the ones that I want. And I was looking for certain aspects of auction behavior to know which stocks were in play. Hired a guy, he built out the model, thought everything was great. And then that's because I didn't know how to I didn't really know what he was building, right? But then as I started spending time with these models, I said, well, hey, just walk me through the logic of this. Like you can literally do that. You can go take the code and you can paste it into Chat GPT and you can say walk me through the logic of this and how do these pieces work? And then it turns out, oh, well, this guy's using 1 day data and I wanted 1 minute bar granularity.
Mm.
And so that meant that the key references that it was teeing off of were completely wrong. Um, he wouldn't know that, right? It's not his fault
Right.
because he's not a domain expert. He doesn't know that it's not generating the right piece. He's just oh, I got market data for this day. And you're yeah, but you got me 1 day data, not 1 minute bars, which can generate a very different result.
Yeah, for sure. Okay, very good. Well, listen, I feel like the small little catch up here has opened up quite the can of worms, and there's some things here I hate to just brush over, but
No,
I know
you're
we have
good.
limited time. So if we
Sure.
can steer this conversation and then maybe circle back around to some other things if there's time at the end. But for our purposes, and where I'd really like to just start the conversation is something you mentioned last time, and I know that you have a framework for a framework of a model that you run through before you enter a trade, and a series of 4 questions that you ask yourself,
Yeah.
being what is the opportunity, what am I willing to risk, what would tell me I'm right, what would tell me I'm wrong.
Mhm.
And if we could just start here and maybe talk to us about those 4 questions and how important this is to you and your trading.
Yeah. It's exceedingly important. It's also at the heart of the process that I use for expressing ideas. So I think let's put it in the context of work that I do develop alongside developing traders. I think you and I talked about this before. There's a unfortunate disadvantage for anybody who's trying to learn on their own in this day and age. There is so much noise and so much being thrown at you. Everybody's got their Discord channel. Everybody's got their YouTube stuff. Like it, and there's in that lots of really, really great stuff. But how would you know? How would
Yeah.
you know if it was effective or not? And I've over the years queued up a number of friends that used to be on the floor in Chicago. I was a little bit late for the floor, so what you consider somebody upstairs. Um, so but of the people that I know on the floor and the people that they knew, I'm always amazed at that they're not significantly nuanced or hyper intelligent people, but yet
Mm,
really, really good traders. And there's a little bit of this myth around markets that you've got to be this intellectual savant to be able to carve out an edge, and that's just categorically not true.
that's
What
right.
you do need, like with any other domain that someone would want to have competence in, you gotta know what parts of this space or this industry, what matters and what doesn't matter.
Mm,
Um, like if let's say that you were let's do an analog. If you were in food service, okay, well, what do you got to have? You got to have me. Like if you've got a restaurant, it's not real complicated. You got to have meals that a broad number of people find attractive and appealing to eat. It's presented well, and the service is when people need something, someone's there. That's not that hard to do, but those are the pieces that you have to have, and you can expand on that with theming and all that stuff. But you can have great theming, but if the food sucks, you've got to have your restaurant. That's the core piece. Markets are no different. It's this
mm,
isn't some this isn't some mystical magical place. There are parts of how markets behave that they've always behaved, and they always will. There are subtle things that impact on a day-to-day basis that are shifts that are new. But if you don't have the part of that always is there, you won't be able to discern the parts that are new. And then when you approach the market, this is taking us back to those 4 questions. Uh, how how you get towards consistency is having consistent processes, both in how you analyze and assess and organize the market information. Like we would say, market generated information, because that's really all it is. When we're looking at price, the price, as some have said, is an advertising mechanism. It's just telling us how participants are thinking around an asset or um, a space. That's just something that we take, and then we organize that to make some assessment on how people are aligned. That's part of a process, but then execution is another process. And I find lots and lots of developing traders, especially self-directed retail, who are of this perspective that every price is actionable and
Hmm.
every time is actionable, and that is just categorically not true. um, there are better times to trade and there are better prices to trade. And if you don't know that, then what will typically happen over time is, I mean, you will be just like glued to the screen because you think that there's something to do at every moment. And I I talk to young traders who are like, oh man, the dream is to be at my screen like trading. Like do that for a decade.
Hmm.
You would rather do something else. Um, if you spend time around people who are either running large quant funds, we're on the floor, market makers, you would be surprised at how little activity there is. One of the things that you miss by not getting to be on the floor is that, like, if you could do that today, you can go to Chicago, you can tour the Merc. It's basically a museum now at this point, right? But as far as the floors are, but there, you note that there are lounges outside of the trading floors. Why? Because there are
Hmm.
lots of times when there was nothing going on. Um, People are not home. And so they knew, hey, this is not a space to be active. I'm going to go somewhere else. And then when the volume of noise would pick up in the pits, that's when they would know to come. So,
Hmm.
and that was always aligned around time. Like there's this whole aspect of a time weighted volume. So, with all of that in place, in the vacuum of self directed development and trying to get to a way that you're showing up the same every time, having a set process can help you make consistent assessments around that. So the four questions become a way that you can look at any trade that you take. So if we take it to the execution side, I can take that and then I can look at every trade that I take. It's important that I give it a name. So if you're pulling the trigger on something, there's some amalgamation of, let's say, indicators or beliefs or whatever that is driving that decision. That's fine. Name that. And hopefully that shows up, more than once. Is they're not one-offs. And
Hmm.
it could be a macro driven thing, it could be a news catalyst thing. I don't care what it is, but like name that thing. And then when you enter that, well, I mean, the first thing is before you enter it is, where do you believe that price will go? Um, and this is always an interesting challenge for developing traders, because when I've done, over the last, I've been doing development now for 8 or 9 years, and I've maybe, on an initial consult with a trader, I could count on my hands the number of times that I was doing an audit of trades, and this is specifically someone who hasn't come from some type of institutional environment, but they came from retail. And I asked, like, like when you got in, like, where were you going to get out? And the exit is the second question, not the first one. And
Hmm.
if you want to be able to immediately start moving towards an institutional mindset as opposed to a retail mindset, you'll start thinking in terms of the destination first. And
Hmm.
this is like one of the things that that made me a zealot for using the profile and using auction theory. It was a framework that better described what prices we were likely to go to based on how we were behaving. So that meant, oh, I could build a trade based on the intended destination, which
Hmm.
then meant that I could set the risk relative to that opportunity, as opposed to what most developing traders do is, the risk is arbitrary. So they'll say, oh, I use a 10-point stop or a 2-point stop. Gang, the market doesn't care about your arbitrary stop. And you're like, well,
Yeah.
it got stopped and then it moved to X, Y price. Yeah, because you weren't actually setting it around something that was defending where other participants were active that were, around that same idea. You're just picking something, random. And so yeah, that's going to happen. So having the first question be, what's the exit, then you can decide the entry. But then once you enter, so like if the conditions to enter towards that are in play, then it becomes okay, every trader is a storyteller. So when you enter a trade, you're telling a story about what you believe will happen. So how should that story play out? Um, that can be the confirmation to help you stay in the trade toward that larger destination. And like for me, like I'm an intraday swing trader. So, I'm looking for, like, if the Nasdaq's 200 points wide, great trade for me is looking for a quarter of that width. So, where can I find 50 points out of that? When you're looking and waiting for 50 points, it can be like, wow, like I'm in there for a while. So what should keep happening? What can I see behaviorally that would say, hey, I made the right decision, stay in it? And then in tandem with that is what shouldn't happen. What shouldn't happen that would be an early clue that this isn't going to play out? And either I cut it early, or, I don't even take my full risk. Like I'm already underwater, but I'm not going to take my full risk off of it because, it, an example would be, hey, if I'm in this trade, I've got a playbook trade that typically when it plays out, it's within 15 minutes. So if I'm like past the 15-minute mark, I start to get nervous, and I'll
Hmm.
go, okay, maybe I just go back to the sidelines, because over and over and over again, when this trade has worked, it's happened very quickly, and this one is not.
Hmm.
So, that's a clue to get out. I think, like, there's not a lot in my approach and process that I can guarantee will make someone better. But if anyone would endeavor to go take their trades and go back and look at any trade that you took, and then say, okay, let me reclassify that trade by, I'm going to give it a name, and then I'm going to use those 4 questions to suss it out. Now, if you can't, if they do that and keep going through that process, a couple things will emerge. One, they will find that, let's say they have a couple different strategies. They'll find the one that is worth being what we call an anchor trade. You'll find one where the performance is heads and shoulders above the rest, and that may not be
Hmm.
the one that you think it is. Um, they're like, I find people that love to fade trends. And
Hmm.
you know enough about markets to know, like, that's a great way to blow up your account.
Sure.
Like trying to catch the turn on a strong thing is a great way. So, you may think that because you may have had like one instance where that actually worked. But if you actually have data that says, hey, every time I've tried that, I suck, like,
Hmm.
you get feedback to, like, well, let's not do that. Or let's put that back in the lab. Let's not put live money around that one. Or this one, I do have a really great performance around that. And that's the one that I'm going to build everything and anchor around. And when stuff's going crazy and doesn't make any sense, I'm going to go back to this anchor trade, and then I can right the ship. That, like, if people will go through that process, I guarantee they'll be better. Um, if you're not somebody who uses auction theory and can anticipate targets, that and targets that the auction actually cares about, meaning there's a reasonable belief of why I'll go to that price. Um,
Yeah.
you can still go back and look at. I mean, this could be as simple as somebody that uses like a moving average crossover, where they could say, okay, well, whenever I go into this trade, what's the typical excursion that I will see off of that, and use that as your initial target to set your risk against.
Hmm.
Um, that can be a way to move towards that. But you do, at some point, you got to start thinking about targets. Otherwise, every trade that you take, um, you have no idea what the outcome is. So then it's really hard to know what the risk is. It also gets hard to know whether I should stay in the trade or stay with that idea or abandon it. And then the other part that happens, I talk about this with our team all the time, is people will say, oh man, I left all this money on the table. I'm sure you've heard that one, right? Like,
Sure.
um, and the reality is that most often traders are not leaving money on the table. And the reason they're not leaving money, so there's really only one place where I think it's reasonable to use that term, is if you have a playbook trade and you got in that trade, spec'd out using the 4 questions, and you're along the way, and there was nothing to negate exit. Like you did the what should happen, what shouldn't happen, and none of the what shouldn't happen has happened yet, but you just get nervous and you take the trade off, and it continues on towards the intended destination that you had. If that happens, then yes, you left money on the table.
Yeah.
But like being in a position for a trade and then it just like exploding in one direction where you had no idea that was coming. Like I had that yesterday in crude. I was already long crude, and then we had that like massive catalyst off of, like it was kind of a sympathy trade from like Brent crude to WTI. Um, like it it was great. And I was happy to take all of that, but that wasn't part of the trade that I had built. So I got the target that I was expecting. Everything else was just a runner, right? You can free yourself psychologically from an expectation of like, oh, I should have been able to capture that, because you
Hmm.
just won't. Like, you can't. There's nobody that's that good. Even, with all of the algos that are out there. I mean, if there's an algo, the best algo in the world, Jim Simmons fund only did 30% a year.
Hmm.
Like,
Yeah.
it's not quite there yet where it's just perfect. So don't think that you have to be perfect either.
Yeah. Okay, very good. A wealth of information here, and to highlight a couple points, because we're talking about this framework of asking these questions before you enter a trade.
Yep.
And part of this of just understanding that the market is, at least for the level that you and I are ever going to be able to understand, a lot of it is just noise. It's just randomness. It isn't something we've seen before. It isn't something that we understand what is most likely to happen next. And of all the prices we see, there's actually going to be very few times that we should be interacting with the market, whether we're in a trade and not micromanaging it, or whether we're looking to get into a trade. And starting off with these four questions, you made the statement that, go back and look at your trades. And then if you were to run those trades that have caused you so many frustrations, run them through this filter of what was the opportunity? Where was this likely to go? And what was the reason I was expecting that? You'll probably just fall short right there of so many of your trades you didn't even have that part anchored in. And then walking through the rest of these questions, what am I willing to risk? Where does the stop need to be on this trade? What would tell me I'm right if this trade is working out? And then what would it look like if this trade was failing? And think about how many times in your personal trades, if you could answer those four questions intelligently and have good reasons to back these things up, anchoring them to playbook trades, which we'll talk about here in just a little bit, this can really change the game. So if you're not finding yourself with any type of a framework to ask yourself these questions, you can steal this and just put it right to use. And I'd be interested to know, on how many times do you feel, just as the day goes on and you sit yourself, looking at the screens. Uh, this is very normal for me, and I'm wondering if you've evolved past this or if this ever goes away. But finding yourself just having that impulse to want to do something, or to want to look for, even be kind of zoomed in, finger on the trigger, looking for an entry, and then I catch myself and just I go back to this very similar thought of, what is my trade idea? Like,
Mm-hmm.
and this would be your equivalent of, where is this likely to go, which is the
Yeah.
first thing I think about. Um, and then I realize I actually don't know what's going on here. I don't know where this is likely to go. Finger off the trigger, and I sit back.
Right.
But a long question: do you find yourself still doing this, or is this something that after years you kind of evolve past?
Well, I've had to set up fences around myself because I'm just as susceptible
Mhm.
to it as anybody else. Um, we can look at some charts here in a second. I've got it set up where we can take a look so you guys can see like what I look at on a intraday basis. But I like the more time I spend looking at a small time frame. So I look at like 30-minute market profile and like a full day volume profile. I don't look at anything smaller than that until I get into an
Oh
area where
wow.
I'm looking to actually be active, because I have learned over the years of, and I started with markets in '09. So like the more spend time looking at a smaller time frame, the more my willpower to resist the urge to participate, I think I will see something and I'll get sucked in. Just like
Yeah.
anybody else. So yeah. So one, by putting the fence and committing to it is one. And I've done a lot of work with mindfulness and meditation, just to be able to like know what's happening in me. Almost like the ability to step outside of yourself and be able to say, oh, here's this emotion that's coming up, or here's this feeling that's coming up, and I have autonomy over that, and I could stop it. So
Yeah.
it's a really important practice for a lot of traders. But the last piece is, and this goes back to the comment about automating things, is I've taken most of my playbook and I've automated it to the point where now I just get alerts.
Wow.
So I can, which allows me to work on other businesses and build other stuff. And I literally just get, an alert that says, hey, this playbook trade is in play. And it doesn't mean like execute here. It just means, the conditions that I set for this thing to be in play are now here. Now I can go look at the smaller time frame stuff and see if there's some triggering behavior that is there. But otherwise, like the less time I can look at charts, the better.
Sure. Yeah, very good. And a lot of wisdom in this idea as well. Ray Dalio says it, don't confuse the way things are for the way that we wish they were.
Yeah.
And the human condition is we have shortcomings and we have, we are susceptible to things. And yeah, they don't go away in some cases. It's not about making them go away, but it's about building up those fences and making sure that we're not just continually making the same mistake over and over again. I'd love to jump into talking more specifically about Playbook,
Yeah.
which ties right into this. But before we do, I have a few questions I wanted to ask you about specifically options activity and how that
Mhm.
affects the futures market
Yeah.
and how you take these things into account. And so
Yes.
maybe just as a first question, what is your thoughts one on options activity and how that affects the futures market?
Yeah.
And what specific options activity is it important to monitor?
So yes, the answer is yes. Options activity is the market. The tail wags the dog, and that has always been the case historically, but it is only this. So this is in the under the category of what about markets has changed. Is it's even more and more important every day in the world that we find ourselves in. One piece of data is like November of last year, we crossed a threshold where more than 75% of all volume that was traded on a given day occurred in options that expired that same day. That
Mm,
is that's never happened in all of market history. Um, so that shift um, towards not just, I mean, option volume continues to expand, but not just that, but in what durations it's active. So like I was one of the guys when people were talking about trading zero DTE. I mean, I was from the camp historically would be like, yeah, that's a great way to lose everything
mm,
is to do zero DET stuff because you're compressing the time frame that you got to be right. And if you're trying to do directional things with options, um, uh, like it's pretty clear how that's going to go. It's not going to go well. And hang on a second, I'm in a playbook trade right here. So I that's one aspect to the question of like, yes, options roll everything. Options control what prices we can go to and when we can break from that. They also control the windows of time where we can move into to wider ranges. So, I mean, it used to be we didn't really care about things like OPEX. I now look at it religiously.
mm,
Um, especially a monthly OPEX or quarterly OPEX. I mean, those are just really significant events and are a foretaste of what happens next. Then, as far as monitoring, I really pay a lot of attention to where a lot of the open interest is. So, which strike prices have the most open interest within the underlying vehicle that I'm looking to be active, and at what expiration is that strike price the most open interest? So, like today, I was watching around 20,100 Qs. The reason for that is that has the highest open interest of any expiration through the end of October. And what that means is so open interest of options that are opened on these contracts. So like let's say an opening could be somebody opens it like they buy the 100s calls or they sell the 100 puts, but they're opening at that strike price. That causes some reflexivity to take place from the market maker who is on the other side of that trade, and then also has to hedge that thing. So those
mm,
become magnets. The closer you get to those, you're causing that market maker to do some hedging activity in response to that original inventory, and that drives markets. And then especially when you're far enough out from expiration that there's still a lot of value in that option. Um, the closer you get to expiration, the less likely those are gonna pull in, but the further out. So that's what I look at, and you can the CME's actually got a great tool that's free, so you don't have to be an institutional trader to get access to it. But it's called a Quick Strike Vol tool. You can just set up a free account on the CME site, and then you can actually go and they have a heat map for every futures product of where was the most active open interest in a specific strike and where was the change day to day, and that can be really insightful of like, okay, where are kind of like the really big magnets in the market.
mm,
Now like there's correlations between that and like a volume profile, because so let's imagine that somebody buys let's just make up a stock, but they buy a 100 call. That means that a market maker is going to sell the 100 call to them, and then they're going to buy shares to offset those deltas at that same price. That will build out the volume profile.
Mm.
Um, so you can actually shortcut it by looking at a volume profile chart across the time frames where you would have options expirations. So that's why I look at like 5 days and 20 days and 90 days, is because those are the expiration cycles. And if you look at those composite volume profiles, you'll see where those bigger magnets are, where those that
Mm.
option, and often they're not always like right on each other, but they're often pretty close. It's a
Yeah,
long
very
ways.
interesting.
Yeah.
Now, when you're looking at monitoring this information, do you have specific trade ideas that come off of this, or is this pretty strictly context for you?
It's primarily context. I'm not um yeah, I'm not looking for specific ideas. What I'm watching my behavior changing. So one of the things that's happened as a result of the increased prevalence of zero DTE is that in 2023 we had the most intraday trend day reversals in history.
Wow.
What does that mean? So that means that, so a classic trend day is, you open, let's say if it's a trend day lower, you open at one price and you close at, your highest price is the first hour, your lowest price is in the last hour. That's a classic trending behavior. And we had a number of days where we're like barreling lower, and then we get to about 1 o'clock Eastern, and then the market reverses. And that's a function of so much activity in zero DTE options, so that, like, let's say they're not buying puts that are like 30 days out, they're buying puts that expire that day. So when the market's dropping and those puts uh, grow in moneyness, they get to a spot where they flip and they start buying calls to hedge off those puts, and then they cover the puts. Well, when they cover the puts, that forces the market maker to buy back inventory, and then that takes us back. And because there's so much gamma in the short duration, like we've totally changed the way that we behave on trend days. Like yesterday, for
Mm.
example, and we were down 500 points in the Nasdaq. In my more than almost 15 years in markets, like to go 500 points down and then rally 250 points,
Hmm.
like that's hard for me to get my head around.
Yeah.
But I have to be open to that now because of that option convexity that takes place. So what I'll
Yeah.
watch is I like Spot Gamma is a great resource. There's a bunch of them out there, but you can watch what they call the gamma flows, and you can see where that pivot happens. And it's a great spot that if you're, like yesterday, like when I was short and you could see it, nobody's buying puts anymore. You're like, yep, it's a good time to cover and get out of Dodge.
Yeah, very good. When you're looking at monitoring options activity, does this help you understand the expected range that we'll see for a futures product?
Yes, absolutely. I mean, I each as part of my process every day when I'm looking at what's possible in the day, I start with the expected range, because
Okay.
it's way better than using an average trading range. An average trading range is a simple metric that looks in the past, but an expected range is looking forward. So if the implied volatility of the product kicks up from you what happened the prior day, then that means that ranges can expand. That's cool. That's a leading forward looking thing, where in ATR is
Hmm.
just an ATR, right? So it's
Yeah.
hard for somebody to know, oh yeah, like I should expect a wider range tomorrow or a shorter range in the next day. So now I have to say about the expected ranges, and I have lots of guys that work on our development desk that they get really enamored by the idea of expected ranges, because they go, oh my gosh, it's like I can program where the top's going to be, or
Mm.
I can program where the bottom's going to be, and that's not how they work. Um, so an expected range is calculated based on options positioning. So there is a stickiness to them, but there's about a 70% probability you'll stay inside of that range. So the way that I use them is not okay, I'm going to get to this price and now I'm going to sell it because we're going to reverse. Like anytime you find yourself going, we're going to, that's a warning. Um,
Yeah.
but what I would do is I would say, okay, let's say that I'm looking, like one of my playbook trades is what I call an extension fade. So we set up the first hour, and then we trade outside of the first hour's range. One of the criteria that would fire off the alert and say that potentially that playbook idea is in there is that we've used at least 75% of the expected range. because that's great, because that tells me we're eating into a lot of that range. The probability of us continuing is getting less and less the further we get into that range. It,
Hmm.
it's not, doesn't mean that it's going to turn, but it just means, hey, now we're at a spot where anybody who's trying to further push that range is starting to stack probabilities against themselves, and that's a
Yeah.
great place if I want to counter it that I could do that. So it's a great tool to ground you contextually and know, like if you're, if the day expected 150 points and you're at 300 points, and you're trying to push, further extremes, there should be a warning in the back of your head of like, okay, how much is left?
Yeah.
There could be a lot left, certainly. I mean, if it's a really emotional day, there could be a lot left, but you have to say, well, like, how much is left? And one of the ways that you build consistency and confidence over time in this business is you stack probabilities in your favor, because there's no guarantees. All you're doing is like, can I stack as many probabilities as I can stack? That process I can trust will get me where I want to be. And when I keep pushing those probabilities is when things start to get squirrely, right?
Yeah.
So
That's exactly right. Now, when you're looking for this expected range, or when you're calculating this and figuring out what you're expecting it to be,
yep.
are you just relying on the VIX, or how are you coming up with this as, let's say, today for the NQ? What was the expected range, and how'd you come up with that?
Yeah. I mean, there are a couple different models that you can use. The classic model is Black-Scholes, and
Hmm.
one. A lot of platforms will give you an implied volatility percentage, and that's the math off Black-Scholes that tells you across a couple different expirations. Primarily, the next primary expirations is calculating what the implied volatility is for that product. So you can take that percentage number, and it's pretty simple math. So you just take the last closing price times the implied volatility percentage times the square root of 1 divided by 252, and that would give you the expected range for the next day. Um, and that again, there's a 70-cent probability that you'll close inside of that range. Now, here's what's really cool is if you want to take that and expand that out. So like I can calculate the weekly expected range. So like on Fridays, I'll take the Friday close, and then I'll take the implied volatility at Friday, and then you do that same equation, but you do 5 divided by 252. And then if you want for the month, you could do 22 divided by 252, because there's,
Mhm.
essentially 22 days, and you could do a whole year. You would do 252 divided by 252, and that would give you for the year. Um, which is, by the way, been one of the reasons I've been kind of bearish about the S&P, is that we're outside of the expected range for the year. Like we're
Okay.
above the expected high from the year. We've exhausted how much range we were expecting.
I want to circle back around to talk specifically about playbook trades. This is
Yep.
something that you're a strong advocate of,
Yep.
and I definitely think that one of the hardest things for people to struggle with is just the randomness of the market and doing too many things that aren't a part of a process. They're just part of, it looks like we're stopping here. It looks like the market's going to turn around. We're overextended, so it has to come back.
Yeah.
Uh, in the process of creating a playbook trade, of taking these repeatable type action that you've seen before, and then being able to put a little bit of structure and some rules around that, so that when you do identify this, you know what to do.
Yeah.
And if the market's moving and you've not identified anything, there's nothing to do
Yep.
except wait for more information. And so I know you're a strong advocate of this, and I think we have a lot of similar ideas, but I'm interested to hear from you. So maybe just as I've kind of introduced it there, but in your mind, when you think of a playbook trade, could
Mm.
you just give us a workable definition of what you mean when you say I
Absolutely.
have a playbook trade?
Yeah, and I'll do that by giving everybody a playbook trade that you can play with. Okay,
Mhm.
so this there's two ideas inside of this, but let's take the first hour's range. So part of getting to a playbook trade and removing the randomness is to say, what are the how can I put myself in control of the market and say, okay, now conditions are there for me to look and to potentially act. So here's how it starts. So the first hour range from auction theory, we call this the initial balance. So
Yep.
take that first hour, let the first hour set up. Okay, now we know from measuring markets behavioral statistics that in 98% of all sessions of any product, we will trade outside of that first hour's range. Okay,
Right.
that's a remarkably significant statistic.
Yeah.
Um, yeah, it's still not a guarantee, and we still have days when we don't. Like yesterday, the Russell did not trade outside of its initial balance, but 98. So if you just sit there and wait, you have an alert: initial IB high or IB low, one of those triggers. So then the playbook idea is, okay, if I go outside of that range, do I go with that at the initial balance when it extends, or do I wait for a pullback? So, like we have a playbook trade called an IBGW. So basically, on the breach of the initial balance, I'm gonna enter right there. Now, for me to enter right there, and the reason that I'm going to enter right there is, so 80% of the volume takes place in the first hour. So anybody who extends that range, that's a way that you can tell who's controlling the auction. So
Yeah.
once someone's extended that range, that to me is the controlling player for the day, and I'd be really cautious about countering that. And if, let's say that I have done, like the Nasdaq is, like right now, we're doing we're doing about 164 points in the first hour. Okay, so let's say we've done 80 points in the first hour, and we're expecting 280 points, and we've done 120 points in the whole session. So that's a lot of range that's out there and available. When we extend that initial balance, that's a good spot to believe, hey, I'm going to get some good excursion. And we also know from behavioral statistics that in about 50% of all instances that we extend the initial balance in one direction, we'll continue on to at least another 50% of whatever that range was. So there's like another 40 points out there to go. So the idea is, hey, if I've got what I call a narrow initial balance, I'm looking to go with strength out of that initial balance and defend against returning back inside of it. And then I'm looking toward, what we call 1.5 the IB, or some other structural reference that would be out there that you'd be looking to achieve as the target. And that, now let's imagine that would be an IBGW. So again, if it's a narrow initial balance or we've been tight early, you're looking to go with strength out of that, and you're defending against returning back inside the initial balance. However, let's say we did a wide initial balance or an average initial balance, which right now is 164 points. So if we've done 150 points, 164 points, or 200 points, and we step out of that IB, I now know who the player in control is. And what I'm going to now look for is I'm going to look for pullbacks into the initial balance range, either back to the developing value of the day or value area low, and then I'm going to establish longs, either back to the middle or to further extension outside of the initial balance. Like, that's repeatable every single day.
Mm.
Absolutely every day. And it doesn't matter what product you're looking to trade. Now that's the real simple place. Of course, there are times when we go neutral, meaning we go to the other side of the initial balance. But hey, that's great. If we go to the other side of the initial balance and go neutral, you're wrong. Get out. But in 98% of all instances, we'll extend the initial balance, and only 30% of those will we go and extend the other side. So that means that the side that we have not extended, it's pretty rare, fairly rare that we'll go and take the other side out. So like even today, we've extended the initial balance in the Nasdaq higher. We're back into that range, so that means I could look for areas back towards like 930 or 950 to establish longs, defending against going neutral, and look for rotations back
Mm-hmm.
up through the range.
Yeah, very good. And so this outlining here this part of the process, which is having the markets that you're trading, having tools that you look at in a way of uh, understanding how you're making sense of the market moves, whether it's a raw statistic or whether it is a tool, maybe something like volume profiling with the initial balance, and then also having just some raw statistics here. But looking for that repeatable type action that we know something is most likely to happen, like breaking the initial balance, and then being able to put some structure around that of what happens next, and shoring up some rules that would tell us how we're entering in this, how we are taking this off for a loss, where our profit targets are going to go, and then having these things summed up so that when you see this action happening, you then have a playbook trade that you can rely on. Is what we're fleshing out here essentially. And so when you're doing this specifically, do you have like a general, let's say, entry technique that you use for trading, or does it vary by each playbook trade? Would it have maybe a specific way you're supposed to enter. So on this one, you need
Yeah.
to be joining the momentum. On this one, you're pulling back on lower volume, or
Yeah. Yeah.
how does that work?
So, and this occurs on all time frames. But there's a concept within auction theory that moves begin from balance. So that means that energy that queues up that's going to lead in directional excursion happens because there's been some inventory compression. So a little bit of consolidation before the trend. So what I'll do is if we're looking for a go with outside the initial balance, I will then look and say, okay, where was the scene or the site of origin of the move that took us out of the initial balance? And that's the first. That's the place that I'm going to nest my stop behind. So I should not come back through that. And then what helps discern that is that there's been like a tight little area of compression in price and also volume at that price. And then what you'll start to see is you're seeing price delta spikes either in a period but also at a price, meaning that there's a if I want to go long, there's a buying imbalance at a price of size. um, so that means that somebody's tipped the scales and now we're going, okay, well, I'm going to nest my stop behind that and I can enter anywhere above that.
Yeah. There's I think a general idea that if we have uh, an important level for maybe support or resistance, or a place where somewhere to start, that if you put your stop right on the other side of that, that it's a, like a sucker stop of sorts.
Yeah.
And I think something that's really key here is, one, we have to put our stop somewhere. We have to have some kind of defined risk to reward. And so often that's a sucker stop when there's no directional bias that you have a likelihood of being right in. So,
Hmm.
as in just finding these places in the price action and trying to execute, sure, probably a lot of those are going to get run over. But when you already have in place a directional edge and a reason to expect that something is likely to happen, and then you rely against these levels, it'll change the game for how often you're getting just chopped out and something like this. Um, okay, so thank you for walking us through kind of the entry part there. We're going to be walking through, and you're going to be visually showing us in more detail to tie these things together. I'll let you share screens in just a moment here. A couple questions before you do, though. When you're tracking just the general KPIs for your trading, are you looking at things generally and individually, or just one or the other? So are you generally understanding how you perform as a trader, or do you break it down so that every one of your playbook trades, just the core KPIs of what that P&L is, what that win percentage is, yada yada?
Yeah, it's important to look at it by playbook trade because that's going to help you know which are the ones that I should be encouraging my business around and which ones need more work. So if you're doing it just in general and you're not breaking it down by playbook trade, I think it can distort the picture when you will definitely have higher performances than other ones. So
Yeah,
I mean the number of instances of a specific playbook idea that I enter in, and then how many of those were winners, and then are those tied to a specific product? It may be that I find that there's one product that I gravitate toward, which is totally fine, and then one playbook idea that I look to express around that, and that's all good as well. So being able to parse those out, I think is really important to know um, where your edge is, and where you should build your business around.
yeah, very good. Thank you. Okay, great. And then, if it's okay, and if you're prepared, if you could share
Yeah.
your screens, I think talking around this idea, and I really think this is a sticking point for so many people, where there's so much trading frustrations that come when we're just interacting in the market and getting caught in the randomness. There is no thing that we have seen before. There is no thing that we know is most likely to happen next. We don't have any of that kind of information, but we're just interacting in the market, chasing stuff around. And by looking at the market as these playbook type trades, where again, these are repeatable type actions that we understand at least what is most likely to happen next, that we can build a trade around, can truly just change the level of mastery we have in our trading and change, the game
Yeah.
completely. And so some of the theory and some of the stuff we've been talking around, but if you could share your screen and more,
Yeah.
let's concrete sort of tie this together on what it actually looks like.
Absolutely.
And we'll add this to the screens, and we should be able to see the screens now. Great.
Awesome. So this is like I'm looking at the Nasdaq right now because I'm in this playbook trade. So one of the ways to get rid of that randomness is to be able to categorize the auction. And I mean, I know there are people that don't use market profile graphics anymore, and I think, man, you're missing a really cool tool for that.
Hmm.
Why? Because there are structural open types and day types that are repeatable. Like I can categorize every open as a specific open type. There's 5 open types and there's 7 day types, and I can any time stop the market and go, okay, this is the open type, this is the day type, and that gives me a clue onto what's going to happen next. Or,
Yeah.
should I be active now or should I not? So, for example, so this long pink, so the pink here is the initial balance. So I use color coding to kind of help me know, um, eliminating things that I don't need to look at. Um, Let me just kind of break these out because this is overnight and then this is the RTH session. But this is a directional open. So a directional open, like one of my playbook trades is a directional open go with. Directional opens often lead to extension of the initial balance in the direction of the directional open, as was the case yesterday.
Hmm.
So that can set my expectation and how I want to align. Whereas today was what we called an open auction in range. So we had overlap between A and B period inside of the prior range. What basically meant was all of the directional conviction from yesterday evaporated. And so that tells me, okay, don't be bearish or looking for lots of follow through today because the open is telling you that there isn't that kind of conviction. So we're going to be essentially pausing and waiting for more information to come into the auction. But then open types, I can then roll those into day types, and that can help me also assess out. Now, most of them are what we call a normal day. So normal day is where, like today, I have the initial balance and I have extension outside of that, where, and I've got, we almost got to 1.5. So we, almost extended this initial balance. It's hidden behind all of these selling imbalances. But if we're back inside the initial balance after getting outside of it, as we call a normal day, it's just a measure that there's just not as much directional conviction. A strong directional day, you'll get outside of the initial balance and you won't come back. A neutral day, we had those. That's where you extend the initial balance on both sides. And then if you close in the middle, that basically means that nobody won that day. It was a wait. Let's wait for something new to come in. Um, Often these will precede a larger move. So interesting that a neutral day preceded a large directional day. However, if you have a directional day or a neutral day, but you close outside of one side of that, that's like really, really strong and highly likely that you're going to get continuation the next day. So all of my playbook trades are built around what is an open type and what's the day type. So that's a way that you can model and say, is this playbook trade in play or not? And then um,
Hmm.
one of the ideas that I'm in, so I'm two playbook ideas that I'm in right now. The first one is what I call high volume node reversal. So you can't see it on this chart, but we've got some significant composite inventory around 20,075. And the idea is this is a high volume node reversal is the playbook idea, is that if we push through an inventory price like that and then back below it, that tells me that that price is in play. And then I can take the short and stop against any further excursion. And then I was looking for the auction to move back to 950. So that's the one idea. So I entered that 60, stop was at 90, and we'll see if we get to 50 here by the close. The second one is a structure cleanup trade. So you can see this little area in here inside the initial balance where we've only traded those prices in one 30-minute period. So there's we call single prints. That's what this highlighted yellow here. That's just weak structure. The auction moved across it really quickly and isn't sure if those prices are valid. So if we're the closer we get to those, the more likely the auction's going to try to test across those. And so I actually added more into this short, looking to clean across those. And now, as you can see here, I'm stopping and holding everything above the initial balance. So what shouldn't happen is I should not be able to get back outside of the initial balance. Once I got back inside, I should stay inside the initial balance. And so that's why my stops are now defending against any further excursion outside of that. So as opposed to where they were initially here, now I've got an excursion in this idea. But in the question 4, what shouldn't happen? Well, I should, and what should happen? I should be able to continue to stay inside the initial balance. What shouldn't happen? I should not be able to get back outside of the initial balance. And so that tells me where my stop should be. That makes sense.
It makes perfect sense. And again, if this is confusing for anybody who's maybe there's some profiling type terms or the day types or something that you're first hearing it. So maybe it's going a little over the head. Just understand the general framework here of having a method that you have mastered, so that when you look at the market, you know how to make sense of this. You're not just looking for entries because you've put two indicators on your chart, but you have
Mhm.
a proper method of way of making sense of what you're seeing. And part of that is going to have these tools that you master, and the understanding that what these tools are telling us, the opening types, the day types, the structure that's being left behind. And then once you have that certain level of mastery, this is when you're able to see repeatable action. And if these tools that you're using are not allowing you to see this information, then you need a better method and a better way of approaching the market. But being able to understand these, what the information is seeing, and then starting to at first identify repeatable action, and then just sussing that out and going deeper of how we can put some rules around that. If this is in fact repeatable action, that puts the edge in my favor, where I understand at least what's most likely to happen in the case of this high volume node, being able to defend that, and then now this is very specific area
Mhm.
that if you're wrong, we're pushing through this. You understand where to take this trade off. If you are right, you understand where it's most likely to go for these next targets to the downside, and just creating this incredible amount of um, mental strain that doesn't have to be there.
Mhm.
Wondering the whole time of, should I be taking this trade off? No, you know where it's most likely to go. If the trade's working against me, where is my exit? All these things are already sorted, and ahead of time. And now it's just the process of paying attention to it in real time. If there's any adjustments that need to be made, and then not micromanaging it as a big part of the job.
Yep.
So yeah, no, it makes perfect sense to me. Very similar to how I trade as well. So this frameworks and these things are exactly what I'm applying. When you are, or I guess even initially when you uh, start building up ideas, that part I think I kind of said already, but I'd be interested if that's the same process or if I had it a little bit off. But are you initially looking for repeatable action that you've seen before, essentially that you can recognize as a pattern of sorts, not necessarily like a head and shoulders, but the market leaves behind patterns.
Yeah.
um, and then you take that pattern, and then you go through a process of understanding if that's anything effective or not, and then putting some rules around it. I think that's what I inferred is the process that I go through. But is there anything to add to that of how exactly you build out a playbook trade?
Yeah. So, I mean, this is where you can use, backtesting tools and so forth can be really helpful because it can allow you to um, measure uh, auction behavior. Like what you're trying to figure out is what's normative auction behavior. How does the auction typically behave? And then that allows you to build. I mean, that's how I built these playbook ideas. Was like I have another playbook trade, which is an extension fade, where I've extended the initial balance, and then I'm looking for a counter trade to that. Well, one of the criteria of that is I'm out past 1.5 the initial balance. Reason for that is, yeah, in 50% of instances where the Nasdaq may get to 1.5 the IB, but only in 17% of the instances does it get to 2x. So there's a significant drop off. So you could just measure that
Yeah.
behaviorally to know that the probability of further extension beyond that diminishes significantly. And so that's a normative auction behavior to know. Okay, yeah, here's now it's okay for me to look for some kind of counter activity because I've exhausted ranges. I'm starting to stretch the probabilities, and so now I can go. So there's lots of great tools and models that are accessible to developing traders to be able to build this kind of stuff and then
Right.
use those as the fodder to generate those ideas.
Yeah, very good. And when you first were going down this road, did you initially start being introduced to somebody as maybe teaching you their playbook trades that you took that and built on, or did it was it a natural process of trial and error in your own trading of just realizing I'm doing too many random things, I need a way to put some structure around this?
More the latter than the former. Um, I mean, there's a heavy contingent even in institutional side of markets that is very narrative driven, and I was looking for ways to structure risk more tightly. Um, Also because of how I wanted to go about my day, I wanted to know like, okay, should I look for anything or should I not? Like is there anything in play or not? When should I pay attention? When should I not? Can I take a break? Can I go for lunch? Am I going to miss something, or at what price should I be active? Like, I wanted those questions answered. And so, I used measurable behavior off of the market profile graphic to help back into those and give myself more structure that even the industry and the people that I was learning from didn't really have.
Yeah. Now, is there ever a time, okay, you have, let's say, 10, 12 playbook trades that you monitor and that you look to execute on. Is there ever a time as the market is just shaping up where you see something that just is incredibly obvious to you that one side is taken over, or there's a place we're likely to go that isn't part of something that you already have structured, so it'd be more discretionary, that is an opportunity that you act on? Or do you only enter and interact in the market when it's a structured playbook trade?
I do well to only act and enter when it's a structured playbook trade.
Sure. Okay.
Um, and that's the key learning of, um, like, one of the tools that we're building right now is an ability to track your playbook trades. And partly because of when I'm doing trade audits for developing traders, the number of times that it's just like, well, I just felt I need to be okay. That feeling. Um, I mean, there is an instinct that's honed that, yeah, like your intuition says yes, should be active, great, but that's not most. So like that is a something that still needs to be, um, kind of honed and developed. And I um, it also makes it really apparent of like, oh yeah, I should be active here, or no, I shouldn't be active here. Um,
Right.
oh, if I just took playbook trades, I'd actually be profitable. Like
Yeah.
all of the ideas of like, oh yeah, I think that'll work. They that don't, yeah, stay away from that stuff.
Yeah, that's exactly right. And the craziest lies are the ones that we tell ourselves. And it is so easy
Oh man,
to
yeah.
have so many of these feelings that, oh, it looks like it's going to do this, or I think it's going to do this. And the two times that we're right about it and we get that right, we remember. And then the eight times that it actually caused us an incredible amount of frustration, we
Oh
lost
my gosh.
money, we tend to just not even remember those things. And we
Yep.
can find ourselves doing horrible things for years and never being just honest and realizing that this isn't working. Like, I'm doing the wrong thing here. Um, and this, is a solution to solve that. If you feel like that's part of your training experience, just doing a lot of random things, having a lot of stresses around not knowing if you should be doing something, if there is something to do when you're in a trade, not understanding if you should take that trade off, or if that trade should keep going, or where you should be looking to get out. All of these things are uh, you're making the decision to make those a part of your trading experience because they don't have to be there. And by creating structure and by using a playbook of sorts, that's how we can combat and solve these issues, and at the same time get rid of a lot of the mental issues that we face, because those mental issues are just as a result of all the randomness that we're being involved with, that again we don't have to be. So
Absolutely.
very good. I know we're very quickly running out of time here, even a little bit over already. Can I ask you this as a closing thought? Is there something that you wish I would have asked you, or a topic that you wish I would have brought up that you think is important that should be discussed?
Hmm. That's a great question. Here's one that I think about is, I encounter people who often talk about needing more, like they're struggling with confidence, and they're talking about controlling their emotions and the mental discipline, and see those as the, like what's the obstacle to you having the outcomes that you want. And they'll say, well, I found an edge, but I'm not consistently profitable, is what's typically said. And so we do a little digging around that. And um, there's this, well, if I just had more confidence in this thing, it'll work out. And the reality is, I don't think that's the case. I think the uncertainty and the lack of confidence comes from the fact that you don't know what you're doing. That's not a popular thing to say, but if you think about any other industry, and if anybody listen to this where trading's not their day job, there's something else that's paying for them to eat. And if they're in a profession, like there's there's this myth that trading is this mystical thing that is just really unique from any other industry. And the reality is the same disciplines that would make you be successful in most industries will make you successful in trading.
Mm,
Um, but you got to do the work, and you have to do the work around the things that actually will move the needle. Now, I would say that is a unique thing about trading is that there are other industries where the ability to find the thing that move the needle is easier than trading because we have closed floors. And so unless you're going to go work for a prop shop or a market maker or a quant fund where you can actually get inside the institutions and see what inputs they're actually looking at, it's a little bit like trying to find a needle in the haystack. But the lack of confidence and the um, emotional stuff, like that's all a function of the fact that you don't know what you're doing. So
mm,
um, using the four questions is a way to get to that, because that'll give you the type of feedback of like, oh, I do know what I'm doing, or I don't know what I'm doing, and that could alleviate some of that psychological and emotional stress.
yeah. No, very good, very good. And of course, operating in this environment, which is very uncertain and incredibly dangerous. Like our finances are at risk, in a very exposed way.
Yep.
And so many of these emotional things we feel, it's a good natural response because you are in most cases in a very dangerous environment that you are not prepared for, and you're not really capable of handling, and you should be scared. You should be caught up in your emotions,
Yep.
and the solution to that is to exactly gain this level of mastery over what you're doing and not figure out how can I tackle this obscure mental issue as thinking that's going to be the thing that solves my problems, but how do I stop putting myself in this position where even a rock solid mindset is going to be freaked out. The same way if you're going to walk into a UFC fight as a professional but not know what you're doing,
Yeah.
regardless how good your mindset is, you're going to be scared. You should be terrified.
Oh yeah.
Um,
Like if you don't know how
yeah.
to how to land a punch, you know, like I had a friend that just he swam a 10-kilometer swim, like a race. 10, like that's insane to me. Um,
Mm,
like you're not going to do that. Like you would be freaked out if you had not done any of the training. You didn't know how to do the hydration and the fuel and your stroke, and didn't have all those mechanics down. Yeah, you should freak out. Like you're going to have a psychological emotional response to that. But if you've done the work around the things that you know will lead to that, I think that's the part that's the hardest part to get around, and it causes the most opportunity cost for developing
mm,
traders, is that there is just not enough accessible foundational pieces for them to grab onto to be a professional, specifically intraday practitioner. I think using auction theory, I mean, that was the thing that unlocked stuff for me, was to think about the market as an auction. So, I mean, Jim Dalton's book Mind Over Markets was fantastic. You can go get the CBOE's market profile manual. You can download the
yeah.
PDF. It's like 275 pages, but that also, I mean, that's an institutional training manual on how to think about markets. Some parts of it are irrelevant, but those are the kinds of
Mm,
foundational pieces that you can build on. And I do one-on-ones with developing traders, and they're like, oh, like I'm adding this thing, is it okay? I'm adding this piece to is that okay? I'm like, absolutely. Like I think indicators and ways to organize the auction are a little bit like makeup. Like if how much makeup should somebody wear? Well, it depends on your face. Like if you need it, dab it on. If you find that something helps you understand the auction, use it. But be able to discern between this is predictive versus this is just helping me organize stuff so I can make better decisions. And use auction theory as the bedrock that builds everything else that you do in markets. Like that answers so many questions that people have. Like if you watch CNBC and Bloomberg, and they'll talk about PE ratios and different things, and like it's we're at 15 PE ratio right now. It's expensive. Well, there have been other times when a 15 PE ratio was cheap. What makes
mm,
the difference? And the difference is human behavior. How do people at that time perceive that? And how are they behaving relative to that tells you what you need to know. It's like Like if you played sports as a kid and you're taught to defend, you're told to look at the hips, like not at somebody's face, because you can get the head fake, but the hips tell you where it's going to go. Looking at
Hmm.
auction inventory tells you where participants are acting across all time frames. So if you're the reason I look at it at a day market profile graphic is because I know there are people looking at 3-minute charts and 1-minute charts and 30-second charts and 1-hour charts and 1-day charts. And I can see where all of the transactions took place for all of those participants. That helps me know that I am picking better spots, regardless of whatever time frame I want to look at act on. Right. So
Yeah. No, very good. Thanks for wrapping us up with that last topic there. I'm glad we went down that road. We'll link in the description the best way to get a hold of you or just to follow along, or if anybody's interested in wherever you're being active, so people can access that. And a lot of great information here. Thank you so much for coming
hey man,
on, giving us the time and sharing with us. And we'll wrap it up right here. So I'll give it over to you just to say the last final goodbye, if there's anything you'd like to say,
yeah,
and then we'll end the stream right here.
yeah. I think that one, just thanks so much for the opportunity. I do want to encourage you that if it is possible to get the outcomes that you want with respect to markets, it does take effort, but it's not this. Um, if you're building it around the parts of markets that actually matter, it gets a lot easier. So pay attention to institutional practitioners. I think Corbs he has lots of the people that my friends and others that are great voices. So keep listening, keep tuning into that. That'll give you voices to follow. That'll help you parse through a lot of the noise and the chaff. And um, especially if you find somebody who's been in the industry and is still doing it and has been doing it for 10 years. Like in this industry,
Mhm.
they're like people that are good for two and a half years, uh, and then they blow up. So like somebody who's like, oh yeah, I've been doing this for 2.5 years and I've got it figured out. And if anybody says that they've got it figured out completely, like run from them.
Yeah.
And if somebody has been around for a long time and they just complain about stuff and say, well, the
Mm.
market's this or that, run from them, because that means that they don't have a continuous improvement mindset. But if you find someone who's like, hey, I'm still a student, I'm still learning, there are things that are evolving and I'm evolving to them, those are the voices to follow.
Yeah. Excellent last words. Let's all hit the like button on the way out. Thanks for being here, everybody, and we'll see you on the next episode. I miss you guys terribly already, but take care, everybody, and goodbye.